Hey, good morning. So this morning I'm going over Cardano futures contract trade that I took last night, and actually my stop loss was hit. So I'm going over this trade to analyze it, and basically just to show that hey, it happens. The trade did eventually go in my direction. I'm going to give you my thoughts on it of why I took the trade, and I'm going to show you exactly what happened as well. So I did not refresh this. So this is from last night. Okay. And it was 93, 95%, 96%, some of them 99% and 100% long on some of these contracts on these exchanges. So immediately I was like, whoa, if that many people are long, let's look for some shorts. So let's go right over here to Cardano, and I wanted to measure, and let's actually go back and do a what I want to say, let's do a bar replay so we could go back to where I was when this occurred. Let's see, what time was that? And back here we go. Okay, so this is what I saw last night, right? All right, so remember all those longs, all right? So look over here. All these people are going long. So I said to myself, well, let me measure, let me see what the retracement level is looking like. Okay. All right. I saw the 61%, and I wanted to take the trade to this area right here with market structure. So this was my target, and it was a 1 to 2. So basically, what I was risking, I could make, 2 times that. My stop loss was placed right here. Now, looking back at this trade, I still would have entered like I did. To be honest, um, I felt like this level was going to hold. We're pretty good, but I did have my stop loss above here, and I went short, and I was waiting for us to hit down here. However, when I did check the trade, I was down a little bit. I did question myself whether or not I just want to go ahead and close the trade and open back up the charts and just see what price is really doing and see if I can just get a better re-entry. But instead, I just closed the app and I really just went to sleep, right? And I woke up, I looked, stop loss hit, I looked at the chart, I said, I figured it possibly could have did that. All right, so let's play a little bit bar by bar on a bigger screen for you guys. All right, so we were a little bit, we good. All right, we good. We get a little bit of rejection on that candle. It's on a 15-minute chart. Okay. All right, now when by the time I looked at my phone, this candle was showing a little bit of I was in the red. All right, because we're going against my trade. I left it alone. All right, back and forth. Let's see if I can make this way bigger for you guys. Yeah, this is much better. Sorry. And that knocked me out the trade. Of course, I was asleep, but that knocked me out. Now, let me do something. Let me look, and I can measure this move. And you notice price did what? It came to the 61. Now, you can't see it because it's jumbled up, but let me see if I can stretch this out for you. Look at this. This is 61% retracement. So you see it came right here and rejected. So, like I said, if I would have just got up, looked at the charts, I possibly could have said, okay, I see what it's doing. So it's a possibility I can take a counter trend uh, trade. But once again, I was asleep, so I missed it. So while I'm doing this analysis, it's not really just to find out if I made a mistake or anything. This is a part of trading. It is what it is. Like, I'm not going to try to go back in hindsight and act like I could have did something better. Um, I was just asleep. So if I was up looking, I may could have managed. Still would have took the L, but I may have managed and seen a way for me to get back into the trade. So we'll play it again. All right, now we got this massive drop from that area. So remember, it was at the 61. We got a nice little rejection. We good to go. Here's a couple opportunities. If I was awake, I could have taken. This level was eliminated because this was a green bar. This bar massively engulfs and eliminates this green, which is what we really want to see. We want to see some bars get eliminated. We got that move. So this could have been an entry point for someone, or maybe you want to do an entry point from the 61% area. All right. Remember, these are downside targets. Targets smash, targets hit, trade success, but stop loss was hit prior. So, what are some of the things that we can learn from this? And you just got to learn that you're not going to win every trade. So, that's it. Uh, but if you keep your risk reward correct, and you keep chugging along, you're gonna be fine. You're gonna make up for it. Um, in the long run. All right, so let's go ahead and forward this all the way through. All right, now check this out. This pattern still possibly could be setting up for potentially either further more downside pressure. All right, so it's not saying that it's over, but we have to be conscious of it. Now, look at this pattern right here. You see this pattern? All right. So when you see this, we called it what? At one point we called the Bart Simpson type pattern because it's like his iconic hairline. All right, we had this nice little drop, we had this nice little rally up, and then we had another drop. Okay. So what we potentially want to look at is this. All right, we had this drop. All right, we're rallying. What we now can do is we can measure to see exactly from this impulse drop here, and we can see where the targets will lie to the downside if we were to continue down. So this could be a region of where price definitely could come to. Next, based off this little impulse move. So this could be a target. Okay. And we'll just basically see exactly where that will put us at with our Fibonacci retracement tool. It puts us right at the 70%, is in between the 70 and 78%, which is a huge key level for the Fibonacci retracement level. All right. So that's that. Um, we see these patterns show up. So this one, it looks a little different, but if you look over here, it's similar. All right. So we got this boom, bam, and then Boom. So remember this move. Boom, bam. All right, doing. Are we looking for the same fate as well? Time will tell. You remember, everything's risk reward. Whatever worked in the past doesn't mean it's going to work in the future. But we do have enough, data where we can analyze it and we can say, 60% of the time, 70% of the time, this pattern plays out. But we look like we're shaping up for this. And a lot of these moves to the upside is our supply zone being um, filled. All right, price moving back up, collecting some orders, which typically are short sellers orders on these. All right, you got these coming back up here, collecting their stop losses like they did mine. So you just saw my stop loss was what? Collected. All right, collected is premium. And then it decides to take the market in the direction that it wanted to go once its bags are filled. So remember, all market prices move because of imbalance. If there were 50 buyers and 50 sellers, we have a basically a neutral market. It's just going to really move sideways or it's going to be flat until something large creates an imbalance to move the market in either direction. It's either there's too many shorts, there's too many longs, or if you want to call them too many bears or too many bulls. There's nothing outside of that. That is it. That's the only thing that moves the market. And does that mean that there's a lot of chances of manipulation? Of course, a big, huge amount, because anything can come in and move it. But you have to understand from a manipulation point, a lot of times it's not going to be beneficial for someone to move a market to an area where there's not going to be enough sufficient uh, buyers or sellers in the market. So why would a bit market maker want to take price somewhere where they can't benefit? You get what I'm saying? So it makes no sense for a market maker to come in, drive price so astronomically high. They know that a lot of people are not going to come in and buy at those prices. So when they hit the sale, who are they selling to? Nothing. So guess what? Their sale orders are so large, it just crashed the market down. But that's not what they want. They want the markets to be efficient. So this is why we see these little areas of dips and rise and dips and rise. We don't want to see too much of an impulse all the time. Okay, so this is a nice little impulsive drop. But on this impulsive drop, there was really not any no not a lot of buyers came in the market. There was, and a lot of the institutions did not get their orders filled. Now you as a retailer, kid, right, this thing is dropping and you want to get out, you can get filled. But if they got, $100 million worth of orders, sale orders, they're not going to get filled right here. Instead, they're going to get filled in these little areas and where price starts to range and move back and forth. Now they're coming off their positions. You can get off in here, but they can't. All right. They're getting off in here, which you can. So it's important to know that being a um being a retail trader actually has its advantages. Because when you so large, certain things that you cannot do. Certain ways you have to buy in the market. You need special accounts, privileges, and access to liquidity pools that is not normal. You don't have to worry about that. You can literally hit a button and you can feel at ease that you're not going to have slippage on your account, which just means that your order did not get filled because of the volatility of the market or the inefficiency of volume being in the market that you go unfilled. And if you trade penny stocks, you probably ran into that issue. I have plenty of times. My account is massively up and I'm hitting the sell button and nothing is being sold because the liquidity is not there, which means that something big came in the market, propped the price up. Okay. Now they may be getting a little bit of field because their order in the order flow books is at a higher level than mine. I mean, in the queue system, if I'm trader number 50,000 and they already have an order set at at 1,000 up on the food chain, they would get filled before I get filled. And by the time price it thinks it's by the time I move up in the queue, price is probably already moved. It's outside of my limit order. So I got to start over from scratch. But that's happened plenty of times. That's why if you trade in certain markets, you need to make sure it's highly liquid. And Forex, I guess crypto was getting there, but we hadn't traded all these other pairs on the futures market in crypto. So we really wouldn't know how the liquidity work because I don't trade everything. But Forex is by far the most liquid market in the world. All right, so that's that little video for today. I hope to make some more for today. Just going over some various trade setups. Oh, so let's do this before we go off. Let me now refresh this and let's see what the orders are looking like. All right, so look, we still are pretty much long. So I still, like I said, I'm still looking for some sales setups on this, and this is on the 4 hour period. So let me go down to the 1 hour. See what 1 hour looking like. All right. So yeah, so we're pretty much still long, and uh, some of the unknown. I mean, not the unknown. Well, not the not the well known um, exchanges. A lot of times, you can see some contrariness in it. So, for instance, this one's 98% long, and then you look, you say, okay, CoinX is 63% short. They're probably the ones that's going to lead the charge, which is weird. But you have to understand that exchanges, they also go against each other too, right? Just like market makers, big banks, institutions, they're trading against each other too. All right, they want to conceal their orders. They have a lot of sophisticated ways of doing that because if they can detect that you're buying equity or some type of project that you know you don't know anything about, that's an advantage. You see, the name of the game is we all should be looking for investments that not everybody is talking about. We only want people to talk about investments when we're ready to start our journey of scaling out or selling. That's the only reason why we want that. I don't want everybody to know about Tesla when back in the day, in 2015 and 16. Amazon, 1997. I was in high school, sophomore, or was a freshman. Freshman. Amazon's like $1.35 a share. None of my classmates, and I'm pretty sure, I mean, maybe some of the families in the building bought, invested, who knows? But I know a vast majority of my friends in my circle, parents knew nothing about it. That was the perfect time. And then we're doing the same thing in crypto. There's a lot of people not talking about a lot of these projects, and it's a lot of suffering, blood in the streets. We get it. But that's why we want to focus on accumulating assets that not everybody is really focusing on so that when the attention comes to them, we're already in prime position to be able to capitalize. But we also want to build our positions in a manner that will allow us to be able to see long-term success 5, 10 years out. Okay, we don't want to get in these positions where we have to liquidate the whole entire position just to make some decent money. We want to be able to scale out in increments and taking profit along the way, and then be able to hold these as collateral, and then to be able to use this leverage later on as the legacy system integrates with the crypto and blockchain systems. Wealth building, it's not pretty. So hit the like button, subscribe. It's your boy E White. You have a wonderful day. Also, um, peace and my condolences to the 9/11 victims. Today is 9/11, so just keep them um, in our thoughts and prayers. I got family from New York too, so I know how that is. So, all right, shout out to all the people who helped the firemen, the police, safety crew, all the people who put their lives on the line on that horrific day. All right, y'all. Y'all have a great one.